Hi everyone, this is Kevin Davey, and thanks for buying my book. And today we're going to talk about 3 excellent entries and how to automate them. So let's get started. So first, for those of you who don't know me, I'll go over quickly who I am, and then we'll jump right into the material. The 3 great entries, we'll learn how to build strategies with them, we'll learn how to automate them, and then how you can actually turn all this into a real business, turn trading into a business. So first, since I'll be showing some results of trading systems, I'm required to put up this US government required disclaimer. Past performance is not indicative of future results. Trading systems are usually made with the benefit of hindsight. All results shown should be treated as hypothetical. Okay? All right, so who am I? I'm a full-time futures trader, and I also do writing, consulting, mentoring, speaking, part-time. This was me a while ago at a conference down in Australia. I have over 25 years of trading experience. Most of that is in futures. I've written a couple trading books. Just a couple of them are shown here. Building Winning Algorithmic Trading Systems, which has won a couple of awards. It came out in 2014. And Intro to Algo Trading. If you don't really know what algo trading is, this is a quick, probably 2-hour read. Pretty nice. If you subscribe to Technical Analysis of Stocks and Commodities magazine, you might see me as a monthly columnist with the Algo Q&A section of the magazine. It's a great magazine, lots of good trading advice there, so check it out. Trading-wise, I was able to finish in second place or in first place 3 years in a row in the World Cup Trading Championships. In each of those years, I got over 100% annual return, and that's a real money, year-long contest with some of the best traders in the world. So that was a fairly significant accomplishment for me in my trading, and it kind of convinced me that I could go on and do full-time trading, which was nice, and which is what I still do today. I've also taught some of the other champions. The 2017 winner, Stefano, he was in New York City for a master class I was teaching. I was one of the teachers at. And you can see him there in the top picture. And then the bottom picture, Petra, who won in 2018 in the same contest. She came to the 2017 master class. So it's pretty neat. I've been able to not only teach some champions, I've been able to be a champion myself. So that just gives you some idea of the material that I give you and how useful it can be to you. All right, so enough about me. Let's talk about some entry signals. Let's build some trading strategies, automate them, put it together with the trading business, okay? Trading's getting tougher. We can't really get around that, but it's definitely getting tougher. And you can see this is the average performance of systematic trading funds. These are professional funds that do trading. And you can see the last 5 years, the trend hasn't been going in the right direction, right? The average fund has been getting worse, and in 2018 it had its worst year in quite a while, where the average fund was down. That's trouble. You know, there's more traders coming in every day, and they're getting more sophisticated, and so we got to keep on our toes with what we're doing, developing trading systems. They have better tools to analyze. The bottom line is you've just got to constantly evolve and improve. So these entries I'm giving you today can help you a little bit because they're a little more sophisticated than your general entries, your simpler entries, although the simple ones can still work. Sometimes you want to get a little more sophisticated, so this kind of gives you some insight into some of the more sophisticated things. But realize, if you're talking about trading entries, that's only a part of the puzzle. And we have entries, exits, diversification, money management, position sizing, trading psychology. All those things fit together to make a portrait of a good trader. So entries are just one piece of it. They're an important piece, of course, but they're only one piece. So keep that in mind as we talk about this today. This won't get you where you don't have to do anything else, just knowing entries. You've got to have other things to it, all these other pieces in place. Good entries with bad money management, you'll still do bad. Good entries with terrible psychology, you're going to lose. Simple as that. Okay, so these entries I'm going to show you, just want to be clear, I'm not the original creator of these, and I'll mention the sources for a couple of them. But what I usually do is I take what other people have created, and I usually use that to build off of. Then that way I'm not creating strategies from scratch. I'm not starting from the beginning and trying to reinvent the wheel. I'll use what other people have done and then just kind of add my own twist to it and my own thoughts and my own, thinking, and hopefully come up with something that's an improvement. And it certainly will be something I like. That's a good path, and I definitely recommend it for you in your trading. All the code that I'm going to talk about today and Workspaces for Tradestation can be found by going to this link, bit.ly/KJ Trading, with the KJ and T all capitalized. So pause the video for a second, write down that link, and then you can go and you can download all of this. And then that way you won't have to worry about recreating what I did. You'll be able to just pull it up and do it immediately. That'll be pretty helpful to you. Okay, so entry number one. This is what I call the big trading fund entry. There's a ton of professional hedge funds and commodity trading advisors, CTAs out there. And a lot of times they're all kind of trading the same way, which is interesting. Obviously, they all have their little nuances and ways of trying to extract a little bit more out of the markets, but in general, you can mimic them pretty easily. How do I know this? Well, this great book, Following the Trend, shows just that, where they create a simple system, which I'm going to show you in a second, and it recreates a lot of the performance of these bigger funds. So for example, the black line in both of these graphs is just a fund, and the dashed line is the author's replicated fund using a simple model. Pretty neat, huh? Starting where the big boys are and how they're trading it is certainly not a bad idea. Don't forget they have all these costs. They take so much of your profit. So being able to mimic them is a good starting point. And of course, then you can always take what they're doing and kind of go a step beyond to suit your own needs. And like a lot of things in trading, this works best as a diversified portfolio, so where you're trading a bunch of different markets. This won't be the holy grail for trading the mini S&P, for example. You got to look at a whole bunch of different markets, then they kind of balance each other out. But if you do that, you can actually get some pretty good performance this way. So here's the entry. It's pretty simple. It's just entering on a breakout in the direction of a longer term trend. And In the accompanying material, I give you this in plain English too, but this is the Tradestation code for it. Pretty simple. Yet, it does a really good job of mimicking what professionals do. In this case, I also give you an exit that's based on a trailing average true range. Again, something that's pretty simple. But a lot of people think, oh, hey, that's too simple, that won't work. But this book, if you get it, you'll see he's got example after example of how this basic model can kind of be tweaked a little bit with position sizing and allocations to mimic all these big funds. And that's pretty incredible that something this simple could do it. And so if you think about your own trading, here's a great starting point. Hey, I'm going to start with what a lot of pros mimics what a lot of pros use, and then I'm going to go and I'm going to try to improve it. That's pretty cool. Okay, so here's a sample trade. You can see the 50 bar moving average, the 100 bar moving average, and what it does, where it buys and then it sells when it hits that trailing stop. Pretty simple. And I just took a 2-year period just to show you what kind of performance you could get. This happens to be with soybean 60-minute. You could do just about anything and you might find some good performance. Now, I don't know if this holds up throughout the history of soybeans. You'd have to look at it. Maybe you need to make some modifications, but the general idea is pretty sound. It did pretty good over this 2-year period. So, like I said, 2-year period, the first thing I would do if you actually go and build a strategy with this, definitely test for more than 2 years. Try some different markets, try some different bar sizes, but be careful about optimizing. Ideally, don't optimize at all. Then you won't have to worry about over-optimizing. Just take the parameters that have already been provided to you and just see it as it works. And the other big thing is in all testing, remember that a great back test is not the goal. It's very hard to think that way because the only thing you can see is the back test. And so everybody has it in their mind that making a better back test is going to make a better system going forward. And that isn't really true at all. It's really that out of sample or that live data and the live results that are really going to show you what the system is capable of. So, be careful about back tests. Okay, so that's entry number 1. Let's jump to entry number 2. This is one that I call a pro trader entry because a lot of pro traders are doing this. They take 2 instruments that should be connected, correlated, however you want to describe it, and they go one instrument with a long trade and the other instrument with a short trade. And then their net exposure theoretically is 0 because they're long one, short the other. And what they do is they enter when the 2 instruments diverge. So if you look here in this big arrow, you can see, in this case, Coke and Pepsi getting away from each other. That's when they'd enter. And what you hope is that they converge back. And you can see it again and again, how they converge back and open up and converge. That's the whole idea behind it. It's considered a market neutral strategy, and you're trading 2 instruments, one long and one short. Okay. The problem with this is a lot of retail software platforms, it's kind of hard to model because a lot of them are set up to only look at one particular market at a time with the strategy. And so then you have to have 2 separate strategies. And if you do that with 2 separate strategies, it's hard to use stop losses because you might exit one and not the other, and then you'll have exposure long or short. So that gets a little kind of tricky. And then the other thing, obviously, you're trading 2 instruments now instead of 1. So now your trading costs have gone way up. They've doubled in effect. And also, the whole concept of this assumes that those markets, those instruments, whatever they are going to come back towards each other when they go away from each other. That might not always happen. So you got to be prepared for that, or it might take a very long time. Coke and Pepsi could diverge and remain diverged for a long, long time. So there are some drawbacks to this kind of entry. Here's an example, though, how you can use it. What I did was I just took a Keltner channel, which is a form of trading bands, sort of like Bollinger Bands, and I basically calculate it based on the close of one data stream minus another. So it's one instrument minus another. And if the value gets outside of the upper Keltner channel, I sell short, saying I sell short the first instrument. Now I'd buy the second one. And then if it goes down below the Keltner channel, then I'd buy. So this particular one's a stop and reverse strategy. I'm always long or always short each instrument. And what I'd have to do, this is half the code. The code for the other instrument would be the exact reverse. So instead of saying sell short here, it would say buy. And instead of saying buy, it would say sell short. Okay, so here's an example with gold and silver. You would think they're both precious metals. They should sort of track each other, right? I'm sure you'll find times when that doesn't happen. So you no need to tell me about it. But in general, that's the idea. And of course, we're testing it to see if it works. So you can see from the charts, they're not perfectly lined up, so it's a little hard to see. But if you looked at it, you would see one going short when the other's going long, and vice versa. And these are always in. If you look at the sample performance over a 2-year period, you've got silver in the gray, or the silver color. You've got gold in sort of the gold color. And then you've got the combination in the light blue curve. And you can see the light blue curve, it does fairly well at the beginning and then kind of is break even to up a little bit. Not great, but it does perform. You could say, well, hey, the silver one looks about just as good. Why don't I just trade that instead of that and gold, right? Why not just trade the silver? Why do I have to go long silver and short gold, or short silver and long gold? Why? If I don't get a big benefit. Well, the benefit isn't always increased profit, okay? In this case, let's take a look at your drawdowns. You run just silver during this period, you had a drawdown of $19,000 in silver. You had a $24,000 in gold, but when you combine them together and trade long one, short the other, you only had a $14,000 drawdown. So your max drawdown decreased. Your required margin is less. So if you look at the margin to trade one futures contract for silver, at the time I'm presenting this, it was $3,700. Gold was $3,900. But if you're long one and short the other, it was only $2,300. The exchange gives you some benefit for being more market neutral. So that's kind of neat, because if you require less margin and your drawdown's less, theoretically you need less money to trade that strategy, and then your annual return could be higher. So for example, if I assume my account size was 3 times the margin plus the max drawdown, I would get 31% annual return with silver, 5% with gold, but if I combine the two, I get 49%. So Lower drawdown, less margin required, higher annual percentage return. That's pretty neat. And the other benefit, you're less prone to market shocks, right? Chances are, if gold will skyrocket, and let's say you're short gold, you're long silver, there's a good chance that whatever caused gold to skyrocket, silver will likely follow along with it. It'll get pulled with it. And so then it's not quite as bad as just being short gold. Yes, you're short gold, but you're also long silver, and you'll make some or maybe all of that money back. So a lot of benefits to doing this kind of pair trading. Okay, if you're going to take what I give you and go with it, obviously test it for more than 2 years. And then, try pairs that make sense. Gold and silver, corn and soybeans, if you're doing futures. Stocks, there's a whole bunch of, you could do Google and Apple, things like that. In the futures world, maybe copper and wheat aren't really a compatible pair. You got to kind of think about it, and what would be the reason that those two should move together? Corn and soybeans, certainly. Wheat and soybeans, wheat and corn, that kind of thing should work. But copper and wheat, or coffee and the euro, I don't know if those would work, and because there's doesn't seem to be a fundamental reason for it, at least that I can think off the top of my head. Now, if you can find one, that'd be good. You should also try to be market neutral, so you might have to play around with contract sizes and the number of contracts and that kind of thing. But you always want to be as close to being neutral as far as your overall position. The final point is you got to be very, very careful if your trading platform doesn't easily allow this, and a lot of platforms don't. Tradestation is a good example. You'd have to use 2 charts with 2 strategies. You could have the strategies talk to each other, but that's a more involved kind of development technique. So it's kind of hard to coordinate the entries and the exits with this, and that's the whole point. You want to do that. So be careful about that. But it's a really neat approach. A lot of pro traders swear by this kind of pair trading, long one, short the other. And it's a little more sophisticated than some simple entries that you could do in a single market, and that's why it might work. Not as many people are doing this. Okay, so the final entry is what I call the small bias entry. It comes from the book Beating the Financial Futures Market by Art Collins. Great book. And what this book does is it shows how small biases can add together to generate signals. What do I mean by that? Well, you have a counter. It's called your bias counter. And just take a look at this entry. I say if the close is greater than the average close of the last 5 bars, I add 1 to my bias. If it's less, I subtract 1. Then I go through a second set of conditions, add or subtract to bias. And then I use one with the RSI and a whole bunch of different things. You can do whatever you want, whatever little things you think might help. And then at the end of the day, you have this addition that will give you a bias number. If it's above a certain threshold, you buy the next bar. And if it's below the threshold, you sell short. So it's complicated in the respect of you have to come up with all these different conditions. But the neat thing is they don't all have to add up. Your threshold can be pretty low if you want it to be. It's something you can play with. And you can have as many or as few of these as you want. If you want 1 condition, you can do it. If you want 20, you can do it. As long as it tests and ends up well, then you're good. So here's one with the entry I just showed you. Here's some sample trades, and this particular point in time looks pretty good. Well, that's partly because I picked that, right? So you got to beware of looking just at a 1 5-day section of chart and get too excited about it because, you know, right to the left or right of this, maybe it was all losing trades. I don't know. And here's an equity curve again over 2 years. This is with crude oil 120 minutes. I just kind of took, for all these strategies, I just kind of took some markets just to see how they worked. I didn't try to say, oh, this is what you should use for all time. Just wanted to give you a sense that, hey, these things can work. But the whole point, obviously, of this video is to get you to actually go and try it yourself and test it yourself and try different markets and all these different variations and that kind of thing. Now, again, I use 2 years data. I don't like using all my data to test with because once you use it all, then you're just kind of optimizing with it, and that's dangerous. But if you want to try it yourself, obviously test with more than 2 years. Again, try different markets, different bar sizes, and try a variety of different things you like. You know, maybe you've always liked doji bars to signal reversals. Well, put that in, and maybe that'll help as one of your biases. I don't know. You got to try it. But above all, you know, try to keep it simple. If you're going with 50 or 60 biases, I don't know how well that'll work. You might just be wasting your time. But, you know, maybe 5 to 10 biases, maybe that will give you something interesting. Okay, so the 3 great entries I shared with you today are the big fund entry, you know, a way to replicate what some of the big funds out there are doing, the pro trader entry, which is the pair trading, long one, short the other, and then the little bias entry. Now, you can email me if you want the workspaces and the code, but I also gave you that link at the beginning. You can go back to it and download all this stuff. And this will get you started, okay? All these entries, and you know, in the one case I give you an exit too, that'll get you started. But there's a lot more to do, a lot more. So don't think you're just going to fire these up and start making money with them tomorrow. There's a lot to do. Getting entries is really, you can think of it as one of your first steps, because then you got to go and create the strategies, right? And then you got to test and evaluate it. And then if it works, then you automate it. And then if you automate enough strategies, maybe you could create a trading business. All these steps are difficult to some degree. You know, the get entry step, that might be the easiest. Now, I've given you 3 really cool entries here. My book has tons more. You know, there's a ton of entries out there on the internet. You could literally test forever with the entries that are available. So that's relatively easy. You just get the entries, you know, putting in the strategy. Okay, if you don't know how to program, that's going to be kind of tough. But once you learn to program, you should just be able to plug in the entries, also the exits, which I didn't even mention here. Put them in to create the strategy. Yeah, but that'll be hard at first. It'll get easier. Then you test and evaluate. And to me, that's the hardest part about all this, because so many people do this incorrectly. It's really hard to test and evaluate without over-optimizing, without curve fitting, making sure you have out-of-sample results. It's just really hard. There's no 2 ways around it. And with all the pitfalls of it, and trust me, I've fallen into all those pitfalls at some point. If you don't know what you're doing, you're gonna screw up, and you're gonna get what you think are nice looking results, but they're never gonna work in real time. And that is just a killer. So once you get past that test and evaluation phase, let's say you create some good strategies, you automate them, That's pretty easy with most trading platforms. It doesn't take a huge leap to turn on the automation. Then you have to get enough of these strategies to actually create a trading business and put it all together with position sizing and allocations and that kind of thing. And again, that's another really hard step. So we've got a couple easy steps, one kind of hard step, and a couple really hard steps. If you want to be successful, you got to get through these though. And if you don't know how to test and evaluate, or you don't know how to automate, you got to search out that advice and get that advice. So here's how I test and evaluate. Now, I don't have time in this video to talk about everything I do. I run a workshop that discusses this, but I go from goals through real money operation. And the way I've set up my process eliminates a lot of the pitfalls that are so easy to fall into. But if you follow this process rigidly, you have a much better chance of creating some strategies that will work in real time. And this is actually a trademarked process that I use. Okay, so let's just say you get through that. You find your own process or use mine or whatever. How do you go and automate it? Well, for the most part, it's just taking an algorithm that you've written, that you've back tested and evaluated, and you just let the computer execute the orders. It will automatically place the buy and sell so you don't have to. And it's pretty easy. It takes a few steps, for example, in Tradestation, but most software allows you to set it up pretty easy. Of course, there's two different routes you could go here. You could go full automation, which is what I do, where pretty much everything's decided by the computer. You could also do partial automation, where maybe you manually enter or exit. That one's a little scarier because you start to put your own decision making or your own ability to follow rules in it. But both can be really good and both can be bad. So think about what you want to do and then set it up that way. So if you always overrule trades, doing full automation probably isn't going to be good for you because you're going to override it and it's going to mess it up. But now if you say, hey, I know I mess things up, so I want something that really works in spite of me, then maybe full automation is a route to go. You got to see what your temperament is. A lot of advantages to automation. It reduces emotion. It doesn't eliminate it, because anytime you're trading with money, there's going to be emotion. Your job at this point is really just not to let things get screwed up, right? The automation takes care of your buying and selling. You just want to make sure things don't get screwed up. It's funny, if you ever hear people saying, hey, automated trading, you get rid of all the emotion, you can pretty much count on the fact they're either a demo trader or a wannabe trader or a failed trader. Almost everyone who trades real money with automation still has some emotions. Now, the emotions change. They might not be as severe either, but they're still there. So remember that. Another advantage, because you have rules, you can back test it, and then you can know that you have an edge that has historically worked. And that helps with your consistency in trading. You always use the same rules. It doesn't depend on your mood today, how you trade. So that's a pretty nice part of automation. And you don't have to sit at the screen all day. How many of us know people who just sit at the screen for hours and hours looking for one elusive trade? Well, now you let the computer pick it. Now, it doesn't mean you can walk away and go spend days on the beach while your computer's making money for you. That's not a good idea either. You want to be kind of close by so you can supervise and watch what you're doing. As Tradestation always says, automated trading is not unattended trading, and that's true. But it is an advantage to not have to sit at the screen all day, every day. Of course, it wouldn't be fair for me to mention advantages if I didn't mention some of the disadvantages. Obviously, the computer in the algorithm is only going to do what you tell it. So if you have a poor strategy, even though the rules are written down, you're going to lose money. And if your setup isn't set up to do automation right, or you keep having internet disconnections and that kind of thing, you're going to lose money. And if you're not monitoring your positions and you forget to roll over or something like that, you're probably going to lose money that way. So yes, automation can help you, but there are disadvantages to it. It's still very easy to lose money, unfortunately. It's not like you just turn it on and walk away and make thousands a day. It just doesn't happen. Okay, so let's just say you've taken the entries I gave you earlier, you tested them with a robust testing method and evaluation method. Now you want to automate it. Well, you got to make sure first of all, your broker and your platform support your automation. You might have to do some programming and that kind of thing. Some trading platforms just don't do it, or don't do it very easily. Others do it very easily. So you want to make sure you have the right setup before you go and do it. Here's an example with Tradestation where once you have your strategy up, it's literally like 6 clicks or selections of a mouse, and then you're automated. Pretty awesome. Once you have it going, test it out in simulation mode for a while. Now, what you're not doing is checking fills and that kind of thing, because simulators usually are pretty suspect as far as how they do that. But what they are good at is seeing, are automated orders being placed when they should be? Does the strategy seem to be behaving with automation? Or are you getting hundreds of orders being sent one after the other, until the exchange gets mad and fines you for sending bogus orders? Well, you can test it out in sim and see if that's the case. Now, most strategies don't fall into that, but it is possible to write code that just is reckless in the way it enters and exits orders. So again, if you're not real sure, maybe you want to hook up with a mentor or a trading coach or an educator who has been through it, knows how to automate, knows what potentially it might work and not work. Maybe you want to do that. Then you go to step 4, you've run it in demo, things look good, then you run it live. Okay? And at first, you definitely want to be sitting there watching it. After a while, maybe you want to do some monitoring where, hey, you're close by and maybe you just get an alert when a signal's entered, or you can use remote desktop software to kind of log in and see what you're doing. But you still want to monitor it and supervise it. That's important. And it's actually an exchange rule too, for at least the futures exchanges. You have to be watching what's going on. Okay, so you do that once for one strategy, then you do it again and again and again, and you got all these strategies. All you do is you put all those steps together, and all of a sudden you've got a little business that involves trading, right? That's really all it is. But realize this is a really hard business. You got to constantly improve, evolve, build better strategies. You're not going to create strategies today and trade them for the next 20 years and then retire. It's probably not going to work that way. Maybe if you get lucky, a couple of your strategies will last that long, but strategies break. They come and go. So if you're thinking of doing this as a business, start small. Don't throw all your capital at it at first. Start small, get some victories, get some wins, get a good rate of return, and then maybe look at growing this business. Okay, so today we've talked about 3 pretty nice entries that should give you a lot of food for thought of things you can do, things you can try. We talked about the big fund entry, where you can replicate big funds with a simple strategy. We talked about the pro trader strategy, where you're doing some kind of pairs trading where you go long and short. And then we talked about the little biases, those real little conditions where they add up, and if enough of them add up, you go long or short. So you can use those or all the other entries I give you to create strategies. But the key, obviously, you got to test and evaluate them properly. So if you don't know how to do that, don't just start optimizing like crazy. It's what most people do, and it almost never works. And certainly I've never met anybody who doesn't have a very good development process who's gone on to succeed. So you really need that. And once you do create some good strategies, look to automate them. And then that allows you to trade even more strategies. And remember, one of the puzzle pieces we talked about earlier was diversification. Trading a whole bunch of strategies in different markets allows you to be diversified. So when you get to that point, then it's just a matter of repetition. Create more of those strategies using your development process. And then eventually, you might be able to build a trading business out of it. Okay, so if you have questions, obviously this isn't live, so email me, kdavey@kgtradingsystems.com. I'll be glad to answer your questions. Again, go to the link to get the code that I gave you earlier. And I want to thank you for watching. I hope you've enjoyed this bonus, and happy trading. Thanks.